the probability, but the possibility of the Sensex touching 1 lakh in the next 5 years?
Let's put it like this. I would be disappointed if the Sensex had not touched 100,000 5 years from now.
Okay, so I'm going to capture and recapture this headline again. You will be disappointed if the Sensex in the next 5 years does not hit 100,000.
Yeah, absolutely.
It can go above 100,000 also.
Well, clearly, yeah.
There is one interaction I personally always look forward to. That is our annual interaction with Chris Wood in India. Chris is an old-time India bull. He's been liking India for obvious reasons. The demographic advantage, great governance, and now renewed vigor in the capex cycle. Chris has always argued that India will always be the oasis in a world when things are drying up. And guess what? His bullishness of India has really earned him the respect and the love and affection of television anchors like me and many of our viewers. Chris, so nice to have you on ET Now. Let's do a high five. How tall are you? I used to always think I'm 6 feet. How tall are you?
6'3".
6'3", no wonder.
I don't know in meters.
When we spoke to you exactly a year ago, you were bullish, but you were not excited. Your view was that India is good, but the monetary cycle uptick had started. Now things are looking different. So are you bullish and excited both?
No, I remain, I would have to admit that tactically I'm more bullish now than a year ago, because a year ago we had just commenced the RBI monetary tightening cycle, and actually at that time the RBI had started off being a bit behind the curve, but we've now had, I believe, nearly 300 basis points of monetary tightening, which is probably more than people thought this time last year, probably more than I thought. So what's been amazing is frankly how resilient the stock market has been during this monetary tightening cycle, more resilient than I or actually my colleagues would have expected. And now my base case, as is the base case of most people now, is that the monetary tightening cycle in India, if not America, is over. So that I think makes the stock market look more interesting tactically. Structurally, I remain as positive on India as ever. But basically, the last year has allowed earnings growth to catch up with valuations.
So would you say Indian markets, for a long-term investor, if you have to look at Indian markets probably from the prism of valuations, are they reasonable or are they attractive?
No, the valuations are okay. They're not super cheap. They're not cheap at all, but they're certainly not crazily expensive. So I would advise your viewers to remain structurally invested in India. And clearly many Indian investors are doing that, because probably the key reason for the stock market's resilience in the last 12 months has been the ongoing flows into the Indian domestic mutual funds, most particularly via these installment payment schemes. And I don't see why that should change.
Chris, are we reaching at a stage where foreign institutional investors who sold into Indian stocks because of compulsive factors, interest rates were moving against us, currency was depreciating, they could be forced to come back? And we've seen evidence of that already in the last 6 weeks.
The foreign investors have started to buy India back, partly because they're coming to India and realizing the story is intact. 2, because they're surprised by the resilience of the market. And 3, because they've started selling China again.
So do you think the flows which have come back into India from foreign investors, they're real and they're here to stay?
I think they're real. There are a lot of foreign investors at this Jefferies conference I was at last week. There were a lot of domestic foreign fund managers. And I believe foreigners historically are moderately overweight India. Normally they'd be more overweight than what they are right now.
So Chris, if you have to really look at India versus rest of the world, each currently right now has an appeal and has a problem. US, fiscal deficit. China, they've not recovered from the COVID drop. Europe, a messy situation in terms of the dependence on high energy prices. What to your mind is the current challenge for India?
No, well, the good thing about India is that the monetary tightening cycle has peaked. The corporate sector is the big corporates are very underleveraged. The banking sector NBL situation is cleaned up. We've just entered the 3rd year of a residential property market upturn, which in my view can run for another 5 years. And we have early, I admit it's only early, but we have early indications that a private sector capex cycle is going to happen. Meanwhile, the Indian government has been running quite big fiscal deficits, but those deficits have been primarily used to finance a big infrastructure build-up, not to finance transfer payments, and visibly you see dramatic improvement in infrastructure. So yes, I think the stars are pretty well aligned. Where the market will probably, in my view, continue to climb a wall of worry, but you are, in 6 months' time, you're going to get growing focus on the election.
A few Indian sweets, if you wish, you can try them. This is called Indian dhokla, and you eat it with chutney. Maybe after the interaction, we can, you may want to taste some Indian sweets. By the way, do you like Indian food?
I love Indian food. I don't eat sweets, but I eat too much Indian food at night.
Which is your all-time favorite? Which is your all-time favorite Indian dish?
Rogan Josh.
Yeah.
I always order Rogan Josh.
Yeah, with the naan.
Yes. Well, it was naan, but now rice, because I've given up gluten. I've tried to give up gluten.
Chris, the election outcome, whether we like it or we don't like, historically will always been a binary event. If not a binary event, it's always been a swing event. But the elections are at least a year away. So do you think, let's say, from May 2023 to May 2024, one should not worry too much about election because this event is at least a year away. We should not start fretting over it right away.
No, I think for the next 6 months it's premature to worry about that. I completely agree. So the key issue for the next several months is, first of all, are we right in our assumption that monetary tightening's peaked? And second is to keep an eye on the on all hints of a capex revival. Also, I think the rural economy, there's some concerns about the rural economy being weak, but it seems to me with the property market clearly in an upturn, it should mean growing construction activity, which should mean more employment opportunities on construction sites, which should mean money going back into the rural area.
As a house, Jefferies and your strategy reports, they always have been bullish on private banks, financials. Now, financials have had a honeymoon period in the last 12, 18 months. Earnings have been strong, margins have been strong. Do you think financials a great story, but it is more like a consensus baked in prices?
No, I have to admit there is a consensus view on owning banks, but I'm going to still own the banks. I've been running my Asia ex-Japan long-only agreed and fair portfolio since 2002. So I would say in the more than 20 years that portfolio has existed, if there's one sector where there's always been an allocation in an Asian context, let alone an Indian context, it's Indian private sector banks. So to me, that story remains intact. That's the most straightforward story in India. So if there's a global investor who wants to invest in India and hasn't got the bandwidth to invest in lots of stocks, that's probably where they're going to invest. But right now, with the monetary tightening cycle over, the obvious place to add to, at least I think it's over, the obvious place to add to exposure is property stocks. So the property stocks went vertical in 2022.
22, yes.
When we got second half of 22, they went vertical because suddenly the market realized the property upturn was finally happening after a 7-year downturn. Last year, they corrected because we're in a monetary tightening cycle. But actually, the property market the actual physical property market kept recovering. So the moment we get hint of easing, the property market stocks will do very well.
So can I say...
the property stocks will do well.
Yeah, so can I say that Chris Wood is in fact urging our viewers that don't buy real estate, but buy real estate stocks in India?
Well, right now, that's the safer trade, but I think they'll both be going up. The other point about real estate is because you had this dramatic, when I say dramatic in its impact, Real Estate Regulation Act, which has caused this dramatic consolidation amongst developers, which means there's a fundamental lack of supply because it's much harder to develop property now from a developer standpoint, because you've got to have the balance sheet to keep 70% of the pre-sale cash flow in escrow, which means that the supply is going to be lagging the demand. So I think it's a very straightforward story.
So Chris, your portfolio is in public domain. So I'm going to just read off the names what Chris Wood's model portfolio currently has. It has Godrej Properties, real estate company, GLF, India's biggest real estate company, Macrotech developer, India's biggest residential real estate company, and I think there is Century Textiles there, which is also real estate play.
Real estate related play.
Yeah. So you pretty much like 4 real estate stocks, even though the weightage of real estate in the Nifty is very low. You are not overweight, but you are double overweight on real estate.
Yeah, but in my Asian portfolio, I added to the real estate stocks last week.
So when you tell your clients about buying into real estate stocks, do you get a pushback or are they open to the idea?
No, I think that domestic institutions here have always had a prejudice against property business, property stocks, because they don't think it's a long-term business. But actually that's a bit strange because people buy property stocks in the UK market, the US market, the Chinese market. So it's really a question of where you believe we are in the cycle. But it may have been, some of these prejudices against the property companies may have been valid in the past, but this time around, given the very dramatic intervention of RERA, you can only be developing in India as a listed company if you've got a strong balance sheet. So you have a dramatic consolidation which should be to the benefit of the survivors.
So if you have to divide the Indian market as per your famous newsletter, greed and fear, which part of the Indian market to your mind comes under overrated or greed category? Which part of the market to your mind comes under the fear category?
No, there's nowhere where we have the greed category in India today. We had the greed category previously in the profitless tech thematic, which was still hadn't completely blown up when I was here last. Those are all these listings, you know, the companies with the sort of new age economy being funded by private equity. So some of those came to market in India, some of the better, and they corrected sharply, along with the correction in those names in the US, but the survivors could do very well. So I don't think we have anywhere of greed in India.
Would you say real estate still comes under that category fear because the disbelief is still high, even though everybody knows real estate sector is moving in the right direction, but still there's a denial and a rebuttal?
Yeah, but it's not complete fear because they are beginning to.
Chris, financials, and let's spend some time because that's the core overweight for India and the core overweight for institutional investors. Financials, they follow a cycle. Sometimes it's a credit cycle advantage, sometimes it's the NPA cycle which we need to track. Where do you think the Indian banking credit cycle currently is at? Is it at a young nascent stage or it is at a mature and nearing a peak stage?
No, I think it's at it's at a relatively young nascent stage because the NPLs based on our charts have basically been cleaned up in the regular banks. Obviously, the non-bank financial sector had its problems, which are basically cleaned up. And it doesn't appear that the system's over-leveraged. There has been growth in unsecured consumer lending, so that we may see some regulatory intervention to try and preemptively address unsecured consumer lending. But my base case is it's not an advanced stage, no. And the other point, which we were addressing before this earlier, is just that the formalization of the economy by all these various digital initiatives just mean a lot of people are entering the economy because of the GST tax. So the GST registrations are well up. So there's probably a lot of small corporates out there who were not basically in the formal system. Now they're in the formal system. So that means they can now borrow from a bank as opposed to borrowing from the unofficial lending market where the rate of borrowing would have been higher. So basically there's a secular change in the business opportunity for the legitimate banks.
Has the decline in crude prices delightfully surprised you?
Yes, it has this year. Yes, it has, because China was. The question on the decline in crude prices was seen, is that the oil market discounting a US recession, or is it just something technical? The other issue is, why hasn't the oil markets received more of a boost from the reopening of the Chinese economy? So on the latter, I believe the Chinese economy, the Chinese stocks are acting like the Chinese economy is collapsing. But actually, the Chinese economy is not booming, but it's definitely, it's improving. So what I've heard on that is that the Chinese stockpiled a lot of oil during the last year or more. So they did opposite from the Americans. The Americans
Reduced
used
their
up a lot of their strategic reserve, and the Chinese did the opposite. But the longer time goes on, the more we should get a boost to demand coming from China. So the real issue is, are we going to have a real recession in the US and Europe? Otherwise, the oil's weakness looks a bit strange.
You added
But anyway, India is obviously able to buy the cheaper oil. So that's been a huge positive, and that will continue.
When we spoke exactly a year ago, you added ONGC into your portfolio. You were bullish on Reliance, and that was a play on the oil cycle.
Well, it's partly a play on the oil cycle, but it's also just partly to hedge the risk that something happened geopolitically to cause oil to go to $150, which would be a negative. So I keep those two stocks in my portfolio. That obviously they were, since I was here, you had that windfall tax.
Yes, yes.
So that's made these stocks less attractive than what they were before, because they're not as geared to higher oil prices as they used to be.
When you reached India, and now that you've stayed in India for over a week, where have you changed your view most drastically after you've met companies and you've interacted with investors within this trip?
No, really, it's just kind of the trip's more confirmed my previous views. So there's a greater optimism on the capex, I would say, than what I was fully aware of. The property market, on the property market, it's actually stronger, but the thing is, it's not, the one weakness on the property market is in the affordable housing area. So all the actions in the middle segment and the high-end segment.
If the Indian economy moves from $3 trillion to $5 trillion, what we debate every day, it's not if, it's the time duration, whether it's 2 years, 3 years, or 5 years. But if the economy goes from 3 trillion to 5 trillion in 3 to 4 years, where do you think the earning entrepreneurship engine would be unleashed? Where do you think, which sector do you think will see the maximum tailwind?
Well, no, there's another whole thing going on, which is a new development. That's obviously the hope that India can build real manufacturing
Supply chain.
And this is partly based on the production-linked incentive schemes, but more importantly, is based on this fundamental reality that all these multinationals, particularly US multinationals, can no longer afford to have all their eggs in one basket in China. So the best example of that is clearly Apple. Apple had all its production in China because China is the most efficient place to produce. It still is. But if I'm running Apple, another major US concern, given this geopolitics right now, you have to build another production facility somewhere else because you have the risk that one day the US Congress orders you out of China. Because it's become clear over the last year and more that the US multinationals in China, be they Apple, be they JP Morgan, be they Nike, have no lobbying power with the US Congress because this the one area we have consensus in Washington amongst these two major political parties is on the China bashing. So they've got to move production. So India has one huge advantage over the other competitors for that production move, which I would say are primarily Vietnam, in Asia, Vietnam, Thailand, Malaysia. On a 20-year view, India offers this big domestic market, as well as being so if India can provide the infrastructure to attract this manufacturing, then you really have an potential on a 10-year view to build critical mass in manufacturing. So I think that's the big new development. But obviously it's very early days.
Why is that there's no IT in your portfolio? Because typically if you look at the India appeal, it starts with banks, there's IT right in the middle, and then there are consumer durables or consumer companies in the center. You don't have consumer discretion in your model portfolio, and I think, I can say it officially, zero IT.
No, I never have IT, but it's not really my area. But no, there's nothing wrong with the IT company. There's an interesting conceptual argument, which I don't know the answer to, which is how will the IT sector cope with AI? I've got, my base case is I'll be able to manage it, but I've got no inside track on that. Personally, right short term, I would favor staple consumers over the discretionary consumers. But this is just tactical.
Have you used ChatGPT to write your free greed and fear
No,
index?
I will never use ChatGPT, but I've never used Facebook. It doesn't stop Facebook going up a lot. So so ChatGPT is kind of irritating actually, because I was hoping this was, I'm always biased in favor of Asia and emerging markets. So Asia emerging markets were set up to outperform this year if China had come back normally, but this AI story, as soon as ChatGPT happened, is created a narrative for the US tech sector which didn't exist.
You know, the food placed on the table, guess what, has been ordered on Zomato.
Yeah.
And Zomato is part of your portfolio. I'm wondering why
I've just added Zomato because I've been under pressure to put that in my portfolio since the IPO, but obviously I didn't. But I think now it's in the long run, this is a very straightforward play on Indian consumption, and the total market cap is very small relative to the potential addressable market. And based on what I've been told, only 6% of the Indian population apparently currently pay for things digitally.
So, Chris, there are a couple of last follow-up questions, and I promise I'll not extend our appointment beyond that. Last 12 to 18 months, we've been in a cycle of interest rate hike globally and locally, and typically when that happens, hard assets do well. Growth stocks, they underperform. Now perhaps we could be in reverse of that. So do you think globally growth stocks could make a comeback? Guess what? I mean, you've got Nvidia, which has already become $1 trillion company.
No, but Nvidia is different, you see. So I put Nvidia in my global portfolio when I realized this GB chat story, because in this, we don't know which form of AI will really take off. So what you want to try and own is the picks and shovels of AI. And apparently it seems to be the case that people need NVIDIA's GPUs to do AI. So that explains why. And basically, the tech sector, as I was saying, now has a new story, because first quarter people were buying all the semiconductor stocks before on the argument that the demand's recovering, but actually all the demand estimates for PCs, smartphones, and regular servers are still going down. So this whole GB chat has just created a new narrative, and you have a spectre of unlimited growth. So that gives a story back to the tech sector.
It's May 2023, but hypothetically, if I take the clock forward to May 2028, and we are having the same chart ordered on the Zomato, and I still have the Greed and Fear newsletter in my hand, what do you think potentially 5 years from now we could be discussing?
5 years from now, we'll be discussing, we might be concerned that the banks and property cycle is peaking.
Okay.
But then the other key issue was whether all this promise of made in India has actually become a reality, because the reduction will either be moved to India or it won't have been. At the moment, this is very early days, but there's promising signs. And then the other question is just this whole, tax revenues growing as a percentage of GDP, and the whole economy becoming more formalized. Has there been more progress on that front?
There are three types of investors. One, who own India. Second, who want to buy India. And three, who've never bought India. What would be advice to all the three categories?
Well, to be fair to the people who never bought India, one complication in India, it's not that easy to buy Indian stocks unless you're set up with FII. It's not like there's hundreds of Indian ADRs. So if you really want everybody to buy India, you just have to make it easier to buy Indian stocks.
And those who are currently invested in Indian stocks, what should they do?
No, the emerging market people will be adding to their Indian exposure now, and global money, which no longer wants to buy Chinese stocks because they're worried that the US government's going to order them to sell the Chinese stocks, or they're worried that if they buy a Chinese stock, it will be sanctioned. So global money is definitely beginning to look to add to exposure to India.
So can I say that the ducks are just aligning correctly in terms of liquidity? Domestic institutional investors are getting inflows.
Absolutely.
Because of SIP. Foreign institutional investors have just about made a comeback. And globally, there are multiple problems which will force foreign investors to double up into India.
Yeah, you see, well, the dedicated emerging market guys are only a little overweight India relative to, they're always overweight India, but they're much less overweight than they used to be, so they can definitely add exposure. But the question is whether global money, which is a much bigger pool, but for India, the benchmark weighting is minute. Will they just come to India just because it's a great story, even though it's a very small part of their index? And I think there's a growing chance they will do.
You track Sensex more than Nifty. And we've discussed this over several engagements and separate interviews. What, to your mind, is not the probability, but the possibility of the Sensex touching 1 lakh in the next 5 years?
1 lakh is
100,000.
Well, I think there's a huge likelihood that, yeah.
I want to hear that loudly.
It's very
You
likely.
say that there's a...
No, that to me is very reasonable. Yeah, very, very easy to see.
So Chris Wood is of the view that in the next 5 years, the Sensex...
Let's put it like this. I would be disappointed if the Sensex had not touched 100,000 5 years from now.
Okay, so I'm going to capture and recapture this headline again. You will be disappointed if the Sensex in the next 5 years does not hit 100,000.
Yeah, absolutely.
It can go above 100,000 also.
Well, clearly, yeah.
If not Indian stocks, where else one could invest in the world?
Well, for investors who believe, like I don't believe the Fed is going to enforce keep monetary policy tight all the way to the US inflation reaching 2%. So I believe they will fudge the 2% target. So I believe that inflation in the US will be structurally higher post-pandemic than before it, say 3-4%. So people who buy that point of view should, they should be looking to add to gold mining stocks. And I think for people who want to invest externally, I think Japan is interesting because it looks like inflation's come back in Japan, and that can mean that Japanese equities could be very attractive, and it could mean that the yen could go up a lot.
Well, Chris Wood, really appreciate your time. So glad that you could take time out to come to our studio and spend this lovely evening with us.
Thank you.